Welcome back, everyone, to the deep dive. This time, we're diving into a classic,
Oh, yeah.
The Little Book of Common Sense Investing
Yeah.
by John Bogle,
Yes. The 10th anniversary edition.
the 10th anniversary edition.
And all the extra goodies.
All kinds of, tables and book lists and all of his wisdom kind of packed in. But I think of this as like a cheat sheet
Yeah.
to Bogle's core investing philosophy, Are you ready for this?
I'm ready. I love how he makes complex ideas so accessible. He really wants to empower those everyday investors.
Yeah.
Like all of us.
Yeah, and he does that right off the bat with a story.
Yes.
Gontroc's family.
Yes.
And it's a charming story, but it also reveals something really, I think, crucial about the system itself.
I think it's a brilliant parable. It really is.
Yeah.
Like, picture this. The Gottschalk's family owns every single company in America.
Okay.
They're reaping all the rewards, the dividends, the earnings, the growth, all of it.
Okay, so they're living the dream.
Living the dream. Right. They're set.
But then some cousins get antsy, and they think they can outsmart each other, right? They want a bigger piece of that pie.
Yeah.
So they start trading shares amongst themselves. They're paying commissions to these brokers, these helpers, as Bogle called them.
Helpers, yeah.
And that's where it gets really interesting, because this trading frenzy actually shrinks their wealth.
Oh.
All those commissions and the capital gains taxes that they have to pay,
Yeah.
it chips away at their returns, even if some of them make good trades.
Oh, interesting.
It's a mirror for how Wall Street often works.
Yeah, I think we're so focused on,
Yeah.
beating the market that we
Yeah.
forget that sometimes just owning pieces of great businesses
Right.
and letting them grow over time
Expenses,
is really the goal.
And
Yeah, go ahead.
that's what Bogle wants you to focus on. It's that investment return, not just the speculative ups and downs.
Right, so what's the difference?
Okay, so think of it this way. The investment return.
Is like the real growth of the business. It's fueled by the earnings, the dividends, the solid foundation.
Yep.
The speculative return
Yeah.
is like the changing price.
That's
It's
right.
driven by emotions.
So that like irrational exuberance or
Exactly, yeah.
whatever.
Fear and greed.
So, but do those emotional swings, do they matter in the long run, or are they meaningless?
Well, they do matter to an extent, but Bogle uses this great example. He says if you invested $1 back in 1900 in the U.S. stock market,
Wow.
it would be worth over $43,000 in 2015.
Wow, so that's
That's the magic of compounding, right? But a big chunk of that growth actually comes from rising price-to-earnings ratios.
so it's not all just like the businesses are growing.
Right, not all business growth.
It's also the multiples are expanding.
Exactly.
Got it.
And he says we shouldn't bank on those same returns going forward.
Right, those multiples can't keep going up forever, can they?
Right, they can't. And, we've had a long run of rising price multiples,
Yeah.
so that has kind of pumped up our returns. But, what goes up must come down.
So you're talking about that reversion to the mean idea,
Exactly.
right? Where
Yeah.
high prices eventually correct and low prices eventually rebound.
It's like a pendulum swinging.
Yeah. Okay, so expecting the past to keep repeating
Yeah.
might lead to some disappointment.
Big time. And this is where his famous advice comes in. Embrace simplicity.
Yeah.
Instead of trying to time the market or pick individual stocks,
Yeah.
he suggests investing in the entire stock market.
Yeah.
Like through a low-cost S&P 500 index fund.
It's like Occam's razor for investing. Just pick the
Exactly.
simplest.
Just choose the simplest solution. Why make it complicated?
But why the S&P 500? Wouldn't it make more sense to invest in like the whole market?
Well, the S&P 500 actually captures about 85% of the U.S. market's value, so...
Oh, okay.
And it's very highly correlated to the total stock market index. To be exact, the correlation is 0.99.
So their performance is almost identical.
Nearly identical, you're not missing out on much.
Okay, got it.
Yeah.
Okay, now I'm curious. Why the huge emphasis on low cost?
Ooh.
Is it really that big of a deal?
It's a huge deal because even small fees compound over time.
Oh, right.
And they really eat away at your returns.
Okay.
He gives this great example of the first index mutual fund investor.
Okay.
This person put in $15,000 back in 1976.
Yeah.
And by 2016, it had grown to over $913,000.
Wow, so almost $1 million.
Almost $1 million from $15,000.
Just from letting it sit.
That's the power of compounding and keeping those costs low.
Wow, that's incredible.
It really is.
Are there any other reasons to be wary of high-fee investments?
Oh, absolutely. Yeah, so data actually shows that, on average, actively managed funds underperform their benchmarks.
Really?
Yes. And then you add in investor behavior like chasing past performance or bad timing,
Yeah.
that gap gets even worse.
Oh, man, so chasing past performance, though.
Nah.
So tempting, but
It's so tempting.
we've all heard that past performance doesn't guarantee future results.
Exactly.
So why is that such a trap?
Well, remember that reversion to the mean?
Yeah.
Well, that applies to funds, too.
Okay.
The top performers, they rarely stay at the top.
Okay.
In fact, Bogle found that only 14% of five-star funds from 2004 kept that rating a decade later.
Oh, wow. So that hot fund that everyone's chasing today
Yeah.
might be a dud in a few years.
Exactly.
Yeah, and that's where his skepticism of certain financial advisors comes in, right?
Yeah, so he saw a potential conflict of interest.
Okay.
Because advisors might earn more by recommending those actively managed funds with the higher fees.
Yeah. Right.
Even if it's not in the client's best interest.
So if we shouldn't chase past performance or blindly trust advisors, how do we choose investments? This is all starting to feel a bit overwhelming, honestly.
Well, that's...
You know what I mean?
Yeah, I know what you mean, but Bogle's message is about empowering you,
Yeah.
not discouraging you. He wants you to take control and stick to the basics. Low-cost index funds that track the whole market.
Simplicity, diversification, low cost.
Exactly.
This is all starting to make sense.
Yeah.
Now, we've covered stocks, but haven't even touched bonds.
Right.
Where do they fit into all of this?
Great question. Bonds are really key for reducing your risk and giving you some downside protection.
Okay.
But as you know, we're in this tricky environment with low interest rates.
So what do? Do we just avoid bonds altogether?
Well, Bogle, true to form, recommends low-cost bond index funds.
Okay.
They actually have a history of outperforming those actively managed bond funds.
Oh, okay.
Junk bonds might offer higher yields, but they come with higher risk, so he's cautious about those.
All right, so we've got our stocks, we've got our bonds.
Mm-hmm.
Now, the big question is, how much of each should we have?
Right.
I know there are all sorts of asset allocation strategies.
Oh, there are so many.
Let's dive into those next time.
Let's do it. Welcome back to our deep dive into Bogle's Little Book of Common Sense Investing.
All right, so...
You know, before we jump into those asset allocation strategies,
Yeah.
I think it's worth pointing out that Bogle also addresses this, bigger anxiety that people have about investing, especially young folks who are just starting out
Yeah.
or worried about the future,
Right.
all those what-ifs.
What if everything collapses? Yeah.
Exactly. He actually includes this letter
All right.
to a hypothetical young investor who's concerned about all these potential catastrophes,
Yeah.
which I think we all think about these days.
Absolutely.
But he reminds us that avoiding investing altogether,
Yeah.
that's actually a recipe for financial failure.
Because even though markets are unpredictable
Yeah.
in the long term, they tend to reflect the growth of the economy and earnings of businesses.
Exactly. It's that long-term perspective that is key here.
Mm-hmm.
Back in 1993, he proposed this simple, low-cost, balanced index fund
Okay.
with a 60-40 stock-bond split. He saw it as kind of a set-it-and-forget-it approach.
Yeah.
You know, just free yourself from all that constant portfolio tweaking.
So it's like having a personal investment advisor, but without those high fees.
Exactly.
Yeah.
And he actually put that idea into practice with a
Right.
Vanguard fund. And looking back over the last 25 years,
Yeah.
it's been remarkably successful.
But wouldn't a portfolio with like 100% stocks
Yeah.
have done even better during that time?
It's true. An all-stock portfolio would have edged out slightly,
Okay.
but it was a closer race than you might think.
Okay.
And remember, past performance isn't everything.
Right, and especially since those
Yeah.
those high returns might be hard to come by going forward.
Exactly. So for investors who are maybe more risk averse or they have a shorter time horizon,
Mm.
that balance can be really crucial.
Okay.
It helps you weather those market downturns
Yeah.
without making rash decisions.
Yeah, that makes sense.
Yeah.
So for someone starting out, a balanced index fund could be a good way to...
It's definitely worth considering.
Yeah.
But Bogle also recognized that 60-40 split,
Yeah.
it's not one size fits all,
Right.
you know? And that's why he introduced the life strategy funds
Oh, yeah, I remember those.
with different asset allocations to suit different needs.
You've got the growth fund, which is 80% stocks.
Yeah, for those who can stomach more risk.
Then you've got moderate growth, which is 60% equities.
Mm-hmm.
Then you've got conservative growth, which is 40%.
Right.
And then you've got the income fund, which is only 20% equities.
Exactly. Exactly.
So there are a lot of options there.
Yeah.
And they all provide global diversification, right?
Right.
They've got U.S. and international stocks and bonds,
All in one package.
all in one package.
And with super low costs.
Speaking of simple strategies,
Right.
Bogle's also a fan of that age-based allocation rule, isn't he?
Oh, he loves that one.
Where your bond percentage equals your age.
Exactly. So if you're 30, you'd
Yeah.
start with 30% bonds, 70% stocks.
And then as you get older, you gradually increase that bond percentage.
Exactly.
But he's not saying everyone has to follow this rigidly.
Of course not. Of course not. You know, someone with a high-risk tolerance and a long time horizon
Yeah.
might stay heavily in stocks.
Right.
The point is to have a plan
Yeah.
and not let market swings or your emotions throw you off course.
Yeah.
Yeah.
Speaking of staying the course, Bogle's a big fan of target date funds too, isn't he?
Oh, he loves those target date funds. He sees them as this, like, brilliant, simplified approach to retirement planning
Okay.
because they automatically rebalance,
Okay.
getting more conservative as you get closer to retirement.
So you can skip all those tricky rebalancing decisions yourself.
Exactly.
Okay.
Always remember his mantra. Look for the low-cost options.
Right. Because those fees can really add up over time.
Big time, especially with retirement investing.
Yeah.
And it's always smart to peek under the hood of any fund.
Okay.
Understand its holdings and fees. You might be surprised how many target date funds are loaded with actively managed funds,
Oh, okay.
which are driving up those costs.
So following Bogle's lead, look for target date funds that primarily use low-cost index funds.
Exactly. Exactly. And don't forget about Social Security.
Oh, right.
He emphasizes that for most retirees,
Yeah.
it's a major source of income
Yeah.
that should be factored into your overall strategy.
That's a good point. Even though it's not technically part of our portfolio,
Right.
it plays a really crucial role.
Absolutely. And he even suggests thinking of Social Security as like a bond-like asset,
Okay.
you know, because it provides that regular stream of income.
That's interesting. Yeah.
Yeah, especially since those income yields on stocks and bonds are pretty low these days.
So relying on dividends and interest alone might not cut it for some people.
Right, and that's where Bogle's total return approach comes in.
Okay.
He advocates for using both dividends and regular withdrawals from your capital to generate that steady income stream during retirement.
But wouldn't that drain your savings faster?
Not necessarily. With a well-planned withdrawal strategy
Oh.
and a diversified portfolio,
Okay.
you can balance your income needs
Okay.
with that long-term sustainability.
Okay, that makes sense.
Yeah, and Bogle actually suggests starting with a withdrawal rate
Okay.
of around 4% of
Okay.
your initial retirement capital,
Right.
and then adjusting for inflation each year.
That's a helpful starting point, but we also need to remember that, like, there are no guarantees.
Right.
Unexpected things can happen.
All the time. Market downturns, you might have surprise expenses.
Right?
Changes in life expectancy, all these things can impact your retirement income.
So being able to adapt is crucial.
Absolutely. Bogle actually encourages adaptability.
Okay.
You know, adjust your withdrawal rates,
Mhm.
maybe even tweak your asset allocation if needed.
Okay, so it's not about being tied to these rigid rules.
Not at all.
It's about being thoughtful and adapting to the situation.
That's doublet. Exactly.
Now, earlier we touched on Bogle's letter to that young investor.
Yeah.
And he brought up this fascinating point about how lower costs
Mm-hmm.
can actually let you take on less risk
Right.
while still reaching your goals.
He did. He gave this example of two portfolios.
Okay.
One with 75% stocks, 25% bonds.
Okay.
The other with 25% stocks, 75% bonds.
Okay, so normally you'd expect that stock-heavy portfolio to have higher returns.
Right, because stocks historically have those higher returns,
Right.
but more volatility.
Yeah, more risk.
But here's the twist. If that lower risk portfolio is
Yeah.
all in low-cost index funds,
Yeah.
and that higher risk portfolio is full of those expensive actively managed funds,
Yeah.
the lower risk portfolio might actually win in the end.
That's pretty counterintuitive.
It is.
Yeah.
It is, because those fees are this like hidden drag on
Yeah.
returns that we don't always realize.
So before even thinking about stocks versus bonds, we need to minimize those costs across our whole portfolio.
Absolutely. It's like, you know, take care of the pennies and the pounds will take care of themselves.
That's exactly.
Bogle's consistently highlighting this, you know,
Yeah.
the importance of owning businesses, keeping those costs low, and letting that compounding do its work over time.
He's such an advocate for the everyday investor.
Yeah.
You know,
Yeah.
like demystifying finance and giving us the tools,
Empowering you?
yeah, to make good decisions.
Absolutely.
So far, we've covered asset allocation,
Mm-hmm.
target date funds,
Yep.
the total return approach to retirement income.
Yep.
We even touched on how lower costs can reduce the need for risk.
Right.
What other insights does Bogle offer in this book?
Well, he has a whole chapter dedicated to the rise of exchange-traded funds.
Oh, yeah, ETFs. Those are everywhere these days.
They are.
What's Bogle's take on those?
Well, he's not totally against them.
Okay.
He does issue some warnings, though.
Okay.
He acknowledges their convenience, the potential for low cost, to invest in different asset classes. But he worries about how they're often used.
Okay. How so? What do you mean?
Well, their original purpose, right, was to
Yeah.
let people track a specific index or sector
Mm-hmm.
efficiently,
Yeah.
similar to traditional index funds.
So, like, you could buy an ETF that has a bunch of stocks
Mm-hmm.
representing, say, the S&P 500
Right.
or the tech sector,
Right.
and you'd benefit from the diversification and low costs.
Exactly.
Yeah.
But somewhere along the way, they kind of morphed into these trading vehicles.
Oh, okay.
People started buying and selling them really frequently,
Mm-hmm.
trying to time the market,
Oh, interesting.
capitalize on these short-term price swings.
So instead of using them for long-term investing,
Right.
they became more tools for speculation.
Exactly. And Bogle argues that this short-term trading behavior
Yeah.
often leads to underperformance. Remember those costs we talked about?
Mm.
The brokerage commissions, the bid-ask spreads,
Mm-hmm.
the taxes,
Yeah.
they all eat into your returns
Yes.
when you're constantly buying and selling.
So ETFs themselves aren't necessarily the problem.
Right.
It's how people use them.
Exactly,
Yeah.
exactly.
Right.
Bogle also distinguishes between ETFs that track these broad market indices
Okay.
and those that try to outperform the market
Okay.
with these smart beta strategies.
Smart beta.
Right.
I feel like he wasn't a huge fan of that.
He is definitely skeptical.
Okay.
He sees many of them as these glorified, actively managed funds,
Yeah.
masquerading as ETFs
Okay.
with higher fees, but no guarantee of better returns.
So instead of simplifying things, they add another layer of complexity and
Exactly.
cost.
Yes, exactly.
So in the world of ETFs,
Mm-hmm.
Bogle's advice is pretty much the same. Keep it simple.
Keep it simple, which circles back to his core message. Investing is a winner's game,
Yeah.
but it's easy to turn it into a loser's game by overcomplicating things and paying too much in fees.
All right. So keep it simple. Keep costs low. Focus on the long term.
Exactly.
I'm absorbing this message.
It's a good word.
So far, we've covered asset allocation, target date funds,
Yep.
the total return approach.
Mm-hmm.
We even touched on how lower costs can reduce the need for risk.
Absolutely.
What else is on the agenda for today's deep dive?
Well, before we wrap up, we got to talk about this crucial concept
Okay.
that's woven throughout this whole book.
Yeah.
It's the relentless power of compounding.
All right, let's talk about compounding then. All right, so we're back for the final part of our deep dive into the little book of common sense investing.
Yes.
And we're going to finish strong with the idea of compounding.
It's a good one to end on.
It is, I mean, there's something almost magical about it, isn't there?
There really is.
It's like watching your money grow
Yeah.
all on its own.
It's pretty remarkable. Even,
Yeah.
Einstein supposedly called it the eighth wonder of the world.
Really?
Yeah.
Wow.
So it's all about earning returns, not just on your initial investment, but also on the accumulated interest or earnings over time.
So it's like that snowball effect, right?
Yeah, I say.
Your money makes more money,
Mm-hmm.
and then that money makes even more money.
That's the idea.
Yeah,
And the longer you let it roll, the bigger that snowball gets.
right.
That's why starting early, even with small amounts, can pay off so much in the long run.
It's like that saying,
Yeah.
the best time to plant a tree was 20 years ago.
Mm-hmm.
The second best time is today.
Exactly. Exactly.
Now, Bogle emphasizes how compounding is kind of a double-edged sword, though.
Oh, it is.
It can boost your gains,
Yeah.
but it can also magnify your losses if you're not careful.
That's right. And those costs we've been discussing.
Right.
The fees, the commissions, the taxes,
Mm-hmm.
they're not just one-time expenses.
Right.
They compound over time,
Oh,
just like your returns.
I see.
So that small fee that seems insignificant now
Yeah.
could actually eat up a huge chunk of your potential earnings.
Down the road. So Bogle's message there is minimize those costs as much as possible.
As much as possible. It's not just about saving money. It's about unleashing the full potential of compounding to work in your favor.
It's like clearing out the weeds in your garden.
Exactly.
So your plants can thrive, yeah.
Exactly.
Now, Bogle's a huge advocate for staying the course, right?
He is.
Riding out market swings, not trying to time things.
Mm-hmm.
But does that mean that investors should be completely passive, never make any adjustments?
That's a great question.
Yeah, I mean, does he ever say
Oh.
when it might make sense to actually deviate from that approach?
Yeah, it does. He does. He actually acknowledges that while tuning out the noise of the market is generally a good idea. There might be some situations where tactical adjustments make sense.
So when? Give me an example.
Well, that's something I'll leave you to ponder.
Oh, come on.
It's a nuanced topic, and there's no easy answer, but it's definitely worth thinking about.
Okay, I like that.
Yeah.
So you're encouraging us to think critically about his philosophy.
Absolutely.
Apply to our own situations.
Yeah.
Not just blindly follow a set of rules.
That's the whole point.
Okay, good.
This deep dive wasn't about handing you a rigid formula.
Yeah.
It was about giving you the knowledge and the tools to make your own informed decisions.
Well, mission accomplished then, I think.
I think so too.
We've explored Bogle's core principles.
Yeah.
Keeping costs low, harnessing the power of compounding, understanding asset allocation, embracing simplicity.
It's a good recipe.
It is. It is a good recipe.
For success.
So thanks for joining us as we explored The Little Book of Common Sense Investing by John Bogle.
It's a classic for a reason.
It is.
It really is.
And we hope you gained some valuable insights to help you navigate the world of investing with more confidence and clarity.
Absolutely.
Remember, investing is a long game. The key is to focus on the long term. Minimize those costs. And let that compounding work its magic.
Oh, let it do its thing.
Let it do its thing. Happy investing, everyone.
Happy investing.